So what made this hard market come along in the first place?
Yeah.
And are the conditions that led to it now answered, fulfilled? Or are we still answering the original questions that caused a turn,
So I think
an inflection point in the previous market?
so. We talked about this in some episodes previously, and I think a couple of the bigger ones being the broader rate environment, interest rate environment, and I think you see this shift in losses. The losses piece. Let's start there. You've had an increase in catastrophes in both frequency and severity, and as we've sort of are heading into what's now been reported as going to be the hottest year on weather, even we know that in advance now, which is concerning to some people, what the impact that might have. But we don't yet know. I don't feel we yet have a lens as to what the new loss equilibrium is. What you saw something was like the number of £1 billion dollar plus losses in a year.
This has been the 6th year in a row that insured disaster losses have been above 100 billion.
Yeah.
Which used to be considered an
Super
exceptional
rare,
year.
yeah.
And again, 100 billion is a number that's not been adjusted, etc. But that still, changes the way that we think about scale here.
So the reinsurers have to enter into a universe in a world where that is what's expected.
But I guess equally, we're looking at a Lloyd's market specifically, to take another example, that's looking at a stamp capacity of 50-something billion of premium, when I think back, 10 years ago and it was on 25. So the amount of premium potentially that's sloshing around has grown quite a bit as well. The world is riskier. Yes, people are spending more on insurance there as well, which I think was a worry for a long time, that as a share of GDP, as a share of the world at risk, insurance was becoming a bit less relevant, arguably, which also may have made things challenging if we were just left with the bad risks.
Yeah.
But you could argue we're trying to track
Yep.
how much riskier the world is coming.
Yeah. So I think piece one will be the market coming to an understanding and to a level of comfort with the loss environment that they expect to be in, and calibrating their internal positions on that, but also maybe improving their ability to model those losses and adjust their prices, and in some cases for a reinsurer, build a portfolio strategy that accounts for certain classes having many large losses, but others being a bit more cyclical or similar. So I think that's the first piece, is getting comfort there. The second piece maybe being the supply, the interest rate environment driving or having an impact on how much supply is coming into the space.
Yeah, I think we had a number of events that we should come back to in a minute, but we had one big hurricane that kicked off sort of much more urgent conversations about rate change this time last year, well, just over a year ago. This year we haven't had that. We haven't had a single big hurricane event that's caused substantial losses.
Yep.
So perhaps this gives a chance of a more asymptotal sort of flattening of the curve for now. But as you said a moment ago, we're going into a El Nino year expected to be the hottest on record, possibly a 1.5 degree change versus pre-industrial levels climate-wise. Who knows what that's going to lead to when we come into next year. So it could be that even if we do have a relaxation from the hard market, in its original level of acceleration, it might be that it picks up again quite quickly after that. So it was event-driven to some extent.